What is going on, Future Focus team? Back at it. My name is George, and we talk about finance and investing in this channel. I'm joined today by my brother. He's a fellow investor, however, he's still new to the game. So, as you're learning, he's also learning as well. So, you guys can learn together. He speaks for those that don't know anything at all because that's where he's kind of at. So, he'll ask questions throughout the video anytime he has some question or something he's not understanding, just to try to speak on the behalf of those who are watching this and may not understand something I'm saying. So, with all that said, today we're going to talk about ETFs and why I choose not to invest in them. Before I even get started with that, just know that I'm not saying that ETFs are a bad investment or that nobody should invest in them. And at the end, I'll get into a few reasons why I feel, for some reason it is a good investment. I'm just going to go through the 5 reasons that I feel that they're not a good investment. All right. So with all that said, let's get into it. So the number one reason I feel that they are not for me is because I don't want to invest in stocks that I don't understand or I don't know. Whenever I invest in a stock or invest in any company at all, I want to know who the CEO is. I want to know what the future of the company is. I want to know what they're doing, why they're doing it. When you invest in an ETF, let me rewind. Jonathan, do you know what an ETF is?
I I rather you elaborate on that, please.
All right, so great. An exchange traded fund, ETF, is a fund that basically think about it as a bucket of stocks. So instead of just investing in one company like Tesla, think about investing in an index or a group of companies at once. So instead of putting $10 into Amazon or Facebook or Tesla, that same $10 could be split between a few different companies, depending on how they're balanced inside of that portfolio. Um, does that make sense to you, or should I elaborate further?
No, I totally understand now.
All right, so it's just a bucket full of stocks. So the S&P 500 is the top 500 market caps in the United States, and it's just an index that tracks them. It is tries to show you as a whole an average of what the biggest companies in the United States are doing. So there's companies in here like Amazon, Microsoft, Tesla, and there's ETFs that follow this index. So it has that ETF contains all, at the most of the time it'll contain all 500 of the stocks inside the S&P 500. So there's two of them that are pretty big. One is called the VOO, which is the Vanguard, and then there's the SPY, which is the spider that track the S&P 500 as an ETF. So these two right here, you can purchase them, and instead of having 500 stocks, you're going to purchase this ETF that tracks all 500. However, inside of that, to get to my first point of investing in things that you don't understand or investing in companies that you don't know, inside of that 500 companies, there may be companies inside there that you don't agree with the things they do. For example, I guarantee you that somewhere in that 500 companies, there's a company in there that does their testing, their research and development on animals. And there's people that are against that. So they may not want to participate in investing in that. And you really don't have an option when you have the ETF. Another thing is like guns. Some of these may purchase, or sell guns or manufacture them, or be somewhere in the chain that delivers these. And you may be investing in those, but you don't believe in guns, and you don't believe that guns should be around. But now you're investing in them. Does that make sense?
Yeah.
Yeah. So that's one of the
Can I
main
ask you
reasons I
one
don't.
question?
Go ahead.
Even though I think it kind of so you kind of answered it, but I just want you to break it down more. What differentiates the S&P 500 from any other stocks? Why? Okay, so we understand that there's some stocks in there that we might not agree with, but why are those stocks all combined in one? What differentiates those 500 from the other million that exist?
So in the stock market, there's over 4,000 stocks. So those 500 are just handpicked by a company with that's called Standard and Poor, and what they do is they have this index which puts these companies in there because The belief is that by tracking these 500 companies, you can track what the American economy is doing as a whole. You can track what the all 4,000 stocks are doing because these 500 are the best ones. So you have really small caps in there. You have some big caps. Tesla was the latest one that was added into the S&P 500. They were just recently added on December 21st. So these are the 500 companies that are focused on giving us an idea of what the broader market is doing as a whole, but looking in one place instead of having to look at what are all 4,500 whatever stocks doing. Let me just see one thing that gives me an idea of what the average is. Because if I have the best companies and the worst companies all doing something at the same time, I could get an average or idea of where everything is at. Because there's companies in there that are there's 11 sectors in the S&P 500. So you have things like tech, you have things like travel. So sometimes tech is going to do good, but travel will do bad, or real estate will do good, and something like restaurants will do bad. Consumer staples or something like that will do bad. So this average allows you to see, over time, what is the broader market doing. Does that make sense? It's called
Yeah,
the
I get it now.
it's called the broader market index. There's that one. There's the Nasdaq, and then there's the Dow Jones Industrial Average. Then there's another one that's called the Russell 2000, which that one has 2,000 in it, and it averages on the 2,000.
But let me ask
So
you this though.
yeah, go ahead.
Pardon me. Based on that information that you're giving us, what stocks would you advocate investing on in the time that we are today?
Uh, can you repeat the question? I'm sorry.
You said that the S&P 500 have 500 stocks there, right?
Yeah.
From the 4,000s or whatever. So I'm saying from those 500, even if I'm a person who doesn't even like to invest in the S&P 500, or somebody who doesn't think that investing in the S&P 500 is a good move right now, let's just say if I had no choice, if I just had some money and I had to invest in the S&P 500, what stocks would you advocate somebody investing in right now in today's date, like in actually today?
All right. So today there's a few because a lot of today is December 28th over here in Japan. Um, Today a lot of the market is overvalued. What that means is that the average price of what a stock should be on all of the stocks around is above fair market value, which is the fair price that you should pay for whatever stock that is. So a lot of these stocks, because we've since March, we've gone like not up in a straight line, but we've gone up since March. In March, I'm not sure if you're aware, the market crashed and it went down a lot.
Yeah,
Since then, we've been on like a upstream. We've the indexes that I referred to, the S&P 500, Nasdaq, the Dow Jones, they're all broken records. Like they're all at their highs. They're all at all time highs. They've reached all time highs. So right now, a lot of the market is overvalued. So there's a few companies out there. I did a video on them a few weeks ago. One is called MP Materials. What this company does is they provide rare earth materials. They're the only ones in the northern hemisphere that provide something called rare earth materials, and they these are things that you need inside cell phones, inside electric vehicles, inside hydrogen vehicles, inside like a lot of things require these satellites. Even the new type of weapon systems that they're trying to develop, they have these type of rare earth materials. Does that make sense?
yeah,
So
it's elements.
that's one company. Another one is Palantir. They provide like this type of analytical data for governments and regular businesses that is constantly learning and evolving. And these are two stocks that they just came into the market recently, and they're two that I still think have a lot of room to grow. Whenever you're investing in something, you want to see it grow 10 times. Like at least you want to make your money multiply 10 times. So if I put in 1,000, I want to get 10,000 from that 1,000 that I put in, and these are companies that we call it 10x. So these are companies that I feel can 10x. And these are just a few examples. There's a bunch out there, but These are just two to answer your question.
Thank you.
But great question, man. Uh, Next, I'm going to talk about fees. And ETFs, they come with fees because they are managed by a company, whether it be Vanguard or a company called ARK Invest. And there's a bunch out there. Um, these companies, they put all these stocks together in one place, but every quarter they rebalance them. And I'll show you an example of what I'm talking about. And here you can see that in this ETF, which is the RAKK uh, Innovation ETF Fund for ARK Invest, they made these transactions on December 24th. These are the companies they invested in. These are the ticker symbols. These are the amount of shares that they have inside this ETF for, let's say, Tesla or Roku. And this is the amount of weight. So, weight just means the amount that they put into this ETF. For Tesla is 9.98%. For Roku, the just think of a pie, 100% is that pie, right? A full pie is 100%. So every quarter, they make sure that the pie contains 9.98%. Well, they try to hit 10% for Tesla. Right now, it's currently 9.98. So if this finishes above 10 at the end of the quarter, they sell shares. And if it finishes below 10 at the end of the quarter, they buy shares. So they always want to be at 10%. The issue with this here comes that, like, you have these companies here, like I referenced earlier, that you may not know or you may not understand. So all these companies here, I can tell you that I don't know who they are, what they are, who their CEOs that are. And let's say they are great companies and they are going to be like the next Apple, the next Amazon, the next Google. You're not really getting that much of it because when you look over here in this portfolio, you're only getting, like Exxon, for example, you're only getting zero point zero 0.04 of this stock. Whatever this company does, whatever they are, all you're getting is this much of this stock. So if it is the next Apple, next Google, or something like that, that's the only amount you're going to cost. So rebalancing cost is something that happens every quarter, or for the S&P 500, like we talked about earlier, it's going to happen anytime that a new stock is taken out or another stock is put in. They're going to buy shares of this stock for that portfolio. And this goes to my next point. Whenever you're investing in something, you want to buy low and you want to sell high. So with ETFs, for example, the S&P 500, when Tesla was added, Tesla was at the most expensive that it's ever been. So they're buying high. When they sold Macy's, when they took Macy's out of the S&P 500, they sold low because Macy's was under its all-time highs when they took it out of the S&P 500. So if you go by the mentality, like Warren Buffett is all buy low, sell high. But if you're investing in ETFs, sometimes they're going to put in a stock in there that's hot, that's like, doing great. But the problem is when a stock is doing great, most of the time it's gone up a lot. So by the time they include it into the ETF, the freaking it's at the most expensive that it's ever been, and you're paying to put that in there. Does that make sense?
Yes, it makes sense.
All right. Reason number four is underperformance. I believe if you're doing your own research, that you can outperform an ETF. Even though ARK Invest, a lot of their ETFs have, the average of them was about 20% that they have returned, which 20% is pretty great. You know, on average, the S&P 500 over the history of it has returned 8% a year on average, which isn't bad. But when you compare that to 20%, you would rather have the 20%, right? But now I look at it this way. Tesla, for example, it went up 700% this year. All right. So it didn't go up to 10% that the 10x that we talked about, but it went up 7x. So it went up a lot. All right. You could have put in 300 in there and you could have sold it for 2,600. Let's say you just bought one share for $300, you could have sold it for 2,000 something dollars, and that's big, right? Whenever you're looking at the index, um, it's in that company. Tesla was inside the Dow Jones Industrial Average. The Dow Jones Industrial Average didn't go up 700%. So if you were investing in the Dow Jones, you wouldn't have gotten the full return of that 700 as if you would have only invested in Tesla. The reason that is because after the March crash, we had something that is called a K-shaped recovery. And all you have to do is think about the letter K. The letter K is a straight line, right? And in that line, you have one line that goes up and one line that goes down that comes off of it, right? So in a K-shaped recovery, you have half the market that does great, but then you have half the market that goes down. So just think about it. What part of the market, you don't even know that much, but just using common sense, what part of the market do you think didn't go up?
Flights,
Yep. So there
travel.
you go. Airlines, travel, they went down a lot. Like I'll give you numbers to make it make more sense for you. Like American Airlines was about 30 something dollars, and it got all the way down to like $10. And even till today, it's only gone back up to like $16. So it's not even back to where it was. But the upper half, the part that went up, you have stocks like Tesla, Zoom, Amazon, Facebook, Google, uh, mostly tech, or what people started referring to as stay-at-home stocks. These stocks outperformed, like they zoomed up. They doubled. Some of them tripled. Tesla 700x. Zoom, when I first bought it, it was like $70, and now it's like over $300. Shopify was about $300. Now Shopify is over $1,200. So a lot of these stay-at-home stocks, they outperformed. But then you have the other side of the recovery, like the ones that are restaurants, travel, cruise lines. They took a long time to recover. And these companies that took a long time to recover, they're inside those indexes as well. So while you have a company like Tesla that's doing so great, they're being weighed down by those companies that are doing horrible. And there's always going to be companies inside the S&P 500 that are doing horrible. Does that make sense? So if you would have just invested in the top 5 companies, you would have done a lot better than if you invested in all the 500 companies. So that's the reason. The next reason is that you are not an owner of any of those stocks when you buy an ETF. All you're an owner of is the ETF itself. So even though that ETF is comprised of all these companies, you don't own shares in those actual companies. You're just owning the average of all those companies. So you're at the end of the day, when I invest in something, it's because I want ownership in it. And if I'm not getting ownership from that ETF, then why even do it? Does that make sense? Um,
Yeah.
so we talked about fees. What I'm gonna do now is just show you quickly um, what fees would look like if you were to invest. So um, investment number 2, you have the VOO, which is the S&P 500 index. And here on the left, investment number 1, you have the ARK Invest. So let's say a scenario where you made an investment of $10,000, and for 30 years, every single year, you put in $5,000, and your investment return average was 6%. At the end of it, investment 1, which was the ARK Invest, which was 7.75, that was an average return. You ended up paying 59,000. Investment number 2, the VOO, you ended up paying 32,000. So now let me do this. Let's say you had the same exact numbers, but you picked the companies on your own, and you didn't pay ARK Invest, or you didn't pay any other company to do it for you. So the least it'll let me do is 0.01. But you'll see here with zero point zero 0.01, you're paying 89,000. With 0.75, you're paying 59,000. So there's a big difference there in the amount of return you're getting back. Now think about if this was zero. Now you have an extra 59,000 at the end of 30 years inside of your bank account, instead of having to have paid all these fees throughout. And these fees are just based on the expense ratio. these fees are not comprised of what you'll see inside the ARK Invest or VOO, which they have these fees that if you look inside the prospectus documents, you'll be able to see them. So here, if you go to ARK Invest, you could look at prospectus here, like you see it here on the left. You could click on that, and what'll come up is like all the warnings and everything you need to know about this ETF, what they invest in, why they invest in it. But the most important thing are the warnings. And they tell you things about these fees that, unless you read that, you're not going to know about. All you're going to know about is the regular expense ratio that you're seeing. All right, but you should look at these. You should, whatever, if you do want to invest in an ETF or any company you're ever going to invest in, you should look at their prospectus. You should look at their quarterly reports. You should look at their
So
annual
where,
reports. What's up?
pardon me, where could I find that website? Where could we find that website?
So up here, you'll see it on the left. For ARK Invest, you can see it at arkfunds.com. But any company you want to look at individually, if you just go to that company's homepage, just look for a section in there that says investors or investor relations or something that has to do with investors. And then they're going to have a whole section that has all the information that you're going to be asking for as an investor of that company. So they're going to have their quarterly reports. They're going to have their tax statements. They're going to have things that, they have to notify the IRS. They're going to tell you all this stuff. Getting back to we were talking about, you're not an owner of it. When you own an ETF, there's other ones out there that they're like a gold ETF or a silver ETF, and soon there's going to be a cryptocurrency ETF that they're trying to get through legislation to be able to put out there. But as of right now, there is none. But you could invest in these companies that are telling you you have gold, like you're paying for the average of what gold is doing. When the price of gold goes up, that ETF goes up. When it goes down, it goes down. However, you don't own gold. All you're buying is a derivative of it. Instead of paying 1,200 and putting it inside that ETF, you could pull out 1,200 and buy silver with that. You could buy the actual commodity. So at the end of the day, you actually own it and you can hold it in your hand. I don't think there's really a reason that you would want to invest in an ETF for a derivative, which is you're just paying for not the real thing, you're paying for a derivative of it. All right, so just to recap, investing in stocks that you don't understand, the fees, buying high and selling low, which you don't want to do as an investor, underperformance because you can outperform the ETFs or indexes by yourself if you do your research and your due diligence, and you are not an owner. And these are the 5 reasons that I don't invest in ETFs. Now, as I stated in the beginning, I do believe that ETFs are for some people. If you want to be a passive investor, which means you don't want to pay attention to where your money's going, then ETFs can be for you. Why? They have a lot of them are diversified, so they have different types of companies in it. So, like the S&P 500, it has all 11 sectors in it. So when you're investing it, the reason to diversify is when something is going up, something else is going down, and vice versa. So you're always stay balanced as you go up. You don't lose all of your investment at one time. When something is really low, the other is high. So you could sell what's high, buy what's low, and then even yourself out again. All right. Another reason is that when you purchase these, you could purchase them and forget about it and just put money in it and money in it, and hopefully with the S&P 500, you'll average an 8% return on your investment. Some years that means some years you're going to do really well, but some years you may even have a negative return. But depending on what your investment horizon is, it might benefit you to invest in these. Um, I do, if you do want to do like an ETF type of thing, one thing I recommend is I'll share a link for it down below. But if you get with M1 Finance, you could create these pies yourself and put companies in there that you want to be in there. And you can theoretically have your own ETF that you build yourself. So one thing you could do is look at the ARK Invest ETF for S&P 500 ETF and pick out the companies that you believe in from there, make your own pie out of those, and you could just put money in there and you'll save yourself from one having those companies that you don't believe in, know, or understand. And you built it yourself. So that means you don't have to pay anybody any management fees, which means more return on your investment at the end of the day. But with all that said, again, my name is George. That's Jonathan. Don't forget to like, comment, subscribe. Share this with your friends because the kind of information out there is lacking. We need more of it. And until next time.